Hello and welcome. So this lecture video is the beginning of Chapter 3 notes. And in this lecture video, I'm going to talk about the concept of the accounting period. I'm going to talk quite a bit about accrual basis accounting versus cash basis accounting and why we use accrual basis accounting for generally accepted accounting principles. I'll also revisit the revenue recognition principle and the matching principle, and then talk about a framework for adjusting journal entries, okay? So let's start off our discussion by talking about the accounting period. So when we go back to some of the assumptions that we made back in Chapter 1, remember we said the going concern assumption. We talked about the time period assumption. That was another assumption, the time period assumption. And remember what that basically says is that an organization can divide its life into discrete time periods. And so when we talk about the accounting period, especially in terms of this class, we're talking about it in terms of 1 year. Okay? Most organizations will use a full year as their primary accounting period. They will issue annual financial statements. They can also prepare financial statements on a quarterly basis, though, which would be interim financial statements. But when we talk about the accounting period in this class, we're talking about a year. Now, does that year have to coincide with the calendar year? As in, does it have to end December 31st? No, it doesn't. There are several organizations, especially governmental organizations, who don't have their fiscal year end 12/31. The federal government, for example, ends their fiscal year on the 30th of September. Okay, so it doesn't have to be 12/31. It doesn't have to be. Although a lot of organizations have their fiscal year, their accounting period, coincides with the end of the calendar year, 12/31. But just know that not all organizations do that, and there's no requirement that they have to, okay? Let's talk about accrual basis versus cash basis accounting. So what we're going to be saying over here is that cash basis, let me jump down here and talk about cash basis first. Cash basis would recognize an expense or revenue when cash is received or spent. Okay? That's not consistent with generally accepted accounting principles, okay? Or IFRS, International Financial Reporting Standards. Accrual basis, on the other hand, remember, accrual basis recognizes revenues when they are earned. That's per the revenue recognition principle. Remember, the revenue recognition principle says that if we make a sale, and even if we don't get paid right away for making that sale, we can still recognize that sale as revenue because of the revenue recognition principle that says we recognize revenue when it's earned, not necessarily when we get paid in cash. They can be at the same time, but they don't have to be. We recognize revenue when we earn it. Okay? That's accrual basis accounting. Cash basis would say, you're not going to recognize revenue until you get paid in cash. All right? That's not consistent with generally accepted accounting principles. Okay? And in this class, we're dealing with generally accepted accounting principles. Further discussing we talked about the revenue side, we'll talk about the expenses. With cash basis accounting, we'd recognize the expense when we paid for it in cash. Okay? Not when the expense was incurred. The idea that we recognize the expense when it's incurred is consistent with the matching principle that says we want to match revenues and expenses in the same accounting period. Okay? So, we're going to recognize with accrual basis accounting, we're going to recognize revenues when they're earned, and we will recognize expenses when they are incurred. That term incurred just means that they occurred. Okay? They occurred. So, for example, we could have rent expense for the month or for the full year. We could say rent expense for the year of $10,000, but we don't pay it until January of the next year. Well, if we're doing cash basis accounting, when would we recognize it? We would recognize it in the next accounting period when we paid it. But that's not consistent with generally accepted accounting principles. Generally accepted accounting principles say you recognize the expense on the income statement in the period in which it's incurred because of the matching principle. So that means what we would have to do is do a journal entry to recognize rent expense that we have incurred but we have not yet paid for, because we'll pay it in the next accounting period in January of the next year. But at the end of this year, on 12/31 of this year, we have to recognize that expense on the income statement this year, even though we don't pay it until next year. Why do we need to do that? Because we recognize the expense when it's incurred. Well, that rent expense was for this year, so we have to recognize it this year. Why do we have to do that? Because of the matching principle. So a lot of the things that we talk about in Accounting 101 all relate back to those core principles that we talked about. The revenue recognition principle, the cost principle, the matching principle, and the full disclosure principle. If you have a good understanding of those principles, all of this should make sense because it's consistent with those principles. Okay? So let's look at another example of cash basis versus accrual basis accounting in terms of insurance expense. Okay? So let's say that Fast Forward pays $2,400 for a 24-month insurance policy that begins December 1st, 2011. Okay, so take a look at this. This is 2 accounting periods. That is 2 accounting periods. Okay, so they're basically paying insurance for 2 years. Okay, so they're buying a 2-year insurance policy, $2,400. So that means, really, if we come over here, we take our $2,400 divided by our 24, that gives us our $100 per month. You can look at it that way. $100 a month. The problem is, this crosses 2 accounting periods. Okay, so if we look at this in terms of just cash basis accounting, we would recognize the expense in the period in which we paid the cash. So that means, in terms of cash basis, this $2,400, all of that would be recognized in December of 2011. We would not recognize any insurance expense. And remember, insurance expense right over here, insurance expense is an expense on the income statement. So remember, the income statement says revenues at a high level, revenues minus expenses gives us net income at a very high level. That insurance expense is another expense here on the income statement. So then what happens to net income in 2011? It goes down by $2,400. So it drops quite a bit because we recognized all $2,400 worth of insurance expense in the period in which we paid the cash. That's cash basis accounting. This is not consistent with GAAP. In terms of accrual basis accounting, which is consistent with GAAP, we would take a different approach. Okay, we would take a different approach. In terms of accrual basis, we would recognize $100, and this is supposed to be 2011, 2012, and 2013. Sorry about that. You can make those adjustments right over there. So we would recognize $100 in 2011. Why 100? Well, look up here. I took $2,400, the total cost, divided by 24, which is the total number of months, gives me $100 a month. So in 2011, I recognize $100. And then look at 2012. I recognize $1,200 in 2012. And then in 2013, I don't have to go to that December down here, so it's just $1,100. So in terms of net income, let's look at the effect of this method versus this method on net income. So in this, if cash basis, what happens to net income in 2011? It drops by $2,400. What happens to net income in 2012 and 2013? There is no insurance expense. It was all recognized in 2011. So what happens to net income in those months? It goes up. So when you have cash basis accounting, you have the risk of net income looking like that, right? Because look, it went down in this month, and then the next in this year, and then the next year it goes up because there was no expense, and so it could cause some wide swings in net income. That's the problem with cash basis accounting. With accrual basis accounting, the expenses are $1,200 in 2012, $100 in 2011, $1,100 in 2013. So what happens to net income? It goes down by $100 in 2011, but that's because we only had 1 month worth of the insurance expense, because it was only for 1 month. In 2012, it goes down, net income goes down by $1,200 because insurance expense is $1,200, and then in 2013 it only goes down by $1,100. So the swings are not as extreme with our accrual basis accounting as they are with our cash basis accounting. The other reason, so that's one reason why we want to use accrual basis accounting, because you can have some big swings in income with cash basis, tends to smooth it out a little bit more with accrual basis accounting. The other thing about accrual basis accounting is that this is consistent with the matching principle. So remember, the matching principle says that we want to match revenues and expenses in the same accounting period. Okay? So think about it this way. This is an insurance policy that covers us over 2 years. And that insurance policy is providing us protection. So we are deriving benefits for using that insurance policy over the next 2 years. Per the matching principle, we should then match the insurance expense in the same accounting period for which we receive the benefits of the insurance policy. I'm going to say that again. We should match the insurance expense in the same accounting periods for which we receive the benefits of that insurance policy. We receive $100 worth of insurance benefits in 2011, so we have $100 worth of insurance expense in 2011. $1,200 worth of insurance benefits in 2012, $1,200 worth of insurance expense. Same thing here with 2013. So by spreading this out, this better matches, the expense is better matched with the periods benefited by the insurance coverage, and that is consistent with the matching principle. And that's why we do it. Okay? So it helps us smooth out some of those big swings in net income. It's also consistent with the matching principle. And the matching principle says we want to recognize revenues and expenses in the same accounting period, or in the context of this expense, we want to match the expense with the periods benefited by the insurance coverage. Well, that means we need to spread it out. And by spreading it out, you don't have big swings in net income. Okay? Let's talk about our revenue recognition and matching principle. I've already kind of talked about the matching principle. Let me just make sure we understand the revenue recognition principle. Again, we earn revenue when we provide the products or services to customers. That means we recognize the revenue when we earn the revenue. That can be at a different point than when we get paid. Okay? So we could, for example, provide some services in 2011, but our customers don't pay us until 2012. When do we recognize the revenue? In 2011, even though we don't get paid until 2012. Why do we do that? Because of the revenue recognition principle. Now, this is a good framework for our adjustments down here. We're going to be doing some adjusting journal entries at the end of the accounting period. Okay? We'll be doing our adjusting journal entries at the end of the accounting period. So we'll be doing our debits and credits, our journal entries for some of these issues down here at the end of the accounting period. We have two different high-level frameworks: paid or received cash before the expense or revenue was recognized. That's called our prepaid expenses. Also unearned revenue. So this is when we paid for that insurance policy 2 years up front. This would be a situation where we get paid up front, but we owe the service. Paid or received cash after the expense is recognized. We'll talk about those in the next lecture video. Thanks.